All right, welcome to Freeman CPA. I'm Greg Freeman, and today we're going to discuss the Qualified Business Income Deduction. Now, the Qualified Business Income Deduction was introduced in 2018, and it basically offers business owners a 20% deduction off of their profit from business. There are absolutely different limitations that apply depending on your income, depending on your profession. So there's, it's not just like a flat 20% deduction based off of your profit. There's calculations that go into play. So the reason we're putting together this video today is basically to go over how important it is to discuss with your accounting team how exactly you're going to go about forming your business. So when you're setting out to do business and you're about to start up, you want to basically pick out the right entity type for your line of work, and there's differences in taxation. As we've explained before, there's an LLC type of formation, or an S Corp type of formation, or a C Corp type of formation. So these are different entity types, and depending on how you form your entity, if you elect to, for example, have your LLC taxed as a single member LLC or a sole proprietorship type of setup, or an S corporation or a C corporation, it will determine how your entity is going to be taxed and exactly how much taxes you're going to pay. So back in the day, like we explained in another video, it was pretty straightforward. In certain states like Florida, when you were choosing a sole proprietorship like an LLC type of taxation versus an S Corp, it was much easier to come to your determination, have a quick consult with a tax professional. Basically, you'd most likely want to start up as an S-type corporation. So in our practice, we'll have many clients that come to us, and they're basically, in the current tax years, they're basically starting up S Corps right away. Whether they started up an LLC and elected to have that LLC taxed as an S Corp, or maybe they started off as a C Corp right away and then converted it to an S Corp. We see a lot of S corporations being formed, and basically we find it to be needless, because you end up actually, in many situations, if you're a small business, you're going to actually end up costing yourself more money in tax savings if your income is under a certain amount, and additionally you'll have the complexities that come along with an S corporation. So an LLC is a very simple form of doing business if you're the only owner. If you're the only owner, and we've explained this before, there's no separate filing. You're basically taxed like a sole proprietorship. There's, if you're reporting your income on your 1040 form, you would just have a subschedule C for profit, and this is where you would report your profits, and it would all just kind of feed into your 1040, and there was no separate filing. It was just another schedule, just like itemized deductions is Schedule A, interest and dividends is Schedule B, capital gains and losses is D. You'd have a Schedule C attached to your return, and it would show all your gross receipts from doing business, all your expenses for the same business, and basically answer many boxes, check boxes. You'd claim your home office, your auto, all these other operating costs. And there was really no distinction between you and your entity. It was kind of treated as a disregarded entity for tax purposes. And so there's very few formalities. Your pocket is almost the same as the LLC's pocket. There's obviously some business formalities you still want to have in place, like you don't want to commingle your funds between your business bank account and so on. But it's still a way simpler form of doing business, and this works great for many people. So when they start up, we want to see a lot of people form an LLC because the LLC is a one-size-fits-all type of entity. The LLC can convert to an S Corp, or it can convert to a C Corp, and it can actually choose to be taxed differently, and then it can go back. It can go back from S Corp, it can go back to being taxed as an LLC. So it gives you a lot of flexibility. So it's a great way to start up your business. But what we're beginning to see after 2018, after this qualified business income deduction came about, is a lot of people would come to us and they started this route and then they landed here as an S Corp right away. So that, they're basically not explained what the differences are between tax types, and they just basically said, here's your election for your S Corp. Go ahead, go form your S Corp, sign off. We'll be treating you as an S Corp. And there was no explanation, nothing. They were just basically thrown into something like that. And that's really a disservice to the client. Now, with not explaining this and not going through the motions with the client and basically educating the client on the differences that suits best for their personal tax situation is a disservice. So we want to avoid that. We want to help educate the general public and let them know about these little intricacies that pertain to the tax code. And these steps can actually save you money. So what happens, and I'll explain it again, when you're forming an LLC and you converted it to an S Corp, what ends up really happening is you get rid of that simplified filing. All of a sudden, now you have to file an 1120S for subchapter S for S corporations, and this is a corporate return now. All right, so you have a separate filing. It's more expensive. There's more accounting work that goes in. Now there's more formalities. You're not treated so much as a disregarded entity, and you and the entity now for tax purposes are not one and the same. So you need to, if you want to put through your automobile expenses or your home office, you need to do it through an accountable plan, through a reimbursement system, and it becomes all of a sudden very cumbersome. And nobody wants to deal with that. Plus, you now have the reasonable compensation. We've explained reasonable compensation in a separate video. Requirements where you have to run a reasonable salary, a W-2, and you have to get paid. So now you're paying for payroll processing. You're incurring costs for payroll processing. You're incurring basically additional accounting costs for filing your S corporation that'll eventually feed into your 1040. So this created a lot of unnecessary tax compliance and work for the accountants. So just doing this is probably going to cost you, depending on where you go, at the least, you're looking at, well, I don't want to throw around any numbers, but because in our profession, there's such a disparity amongst professionals that we see people charging very low ball pricing for corporate filings. But I think if you go to a reputable firm and you're dealing with payroll processing, guidance on everything that deals with the S corporation, and all those intricacies that deal with the formalities that now is restricted upon you, you're probably going to spend about $3,000 per year just for the compliance end of it. So you just cost yourself $3K by doing this election, not understanding what it is that you're signing up for. And like I said, many of our clients that come to us, they've already went through this process and they already started this conversion because they were ill-advised. And somebody just gave them the S Corp election, said, go file it. You're good to go. Don't worry about it. And they just, they didn't really have a choice. They were just told that this is better for them. Well, we're here to explain that it's not always better, and it's good to understand a couple of basic rules and mechanics of what's happening in the background before you go ahead and blindly put your faith into somebody's misguided advice and costing yourself money in tax preparation and compliance services. So let's talk 2 minutes about the qualified business income deduction. That's a new deduction that came out of 2018 tax reform, and they said if you're in business, in the very simplistic format, which will apply to many people, you're getting 20% off your profit from business. So if I made 100,000, and let's make it very simple, if I made 100,000 in profits from my business, that means I have a qualified business income, and I'm eligible for qualified business income deduction. That's going to be 20% deduction. So if we're multiplying 20% by 100,000, that's a $20,000 deduction that I just stumbled upon that wasn't there before 2018. This is like a tax holiday. We were joking about it, saying it's the best time to be in business because now we have, where we didn't have anything for doing business, we all of a sudden have $20,000 deduction just for being in business. Now, like I said, there are limitations that apply to certain industries and certain amount of taxable income. So but again, that won't apply to many people, especially if they're starting out in business. So you have to look at all the variables before you actually make any kind of decisions. And that's the great part about it, is because when you start off with an LLC, you don't have to jump into that S Corp. You can start as the LLC, and if you need to convert it down the road for tax purposes, you do so, and then you see if it still warrants that conversion. So the threshold for 20, I said 20% deduction off of your profit, but if your taxable income exceeds a certain amount in 2021, then you're going to end up losing some of that deduction of 20%. And as you go up in taxable income, you'll get to a threshold. So it's like what we call a phase out. So here's one point, here's another point. And if this line represents your taxable income and you're single, right? And let's say this is for 2020. Now 2021 has updated. It hasn't changed much, but if your taxable income is between $163,300,000 all the way up until $213,300. If your taxable income is in between this range, your QBID, Qualified Income Business Deduction, starts to slowly decrease by a certain amount. And if you're in a certain industry, once you pass this point, you get zero deduction altogether. All right, but I'm not going to go into which industries that is or anything. This video is geared to everything at or below your threshold. And by the way, for married individuals, and this is for 2020, it's slightly higher. It's 326,600 and 426,600, and that's for married filing jointly. And again, that's the same idea, the same tax year. 2021, that's updated. So it hasn't changed dramatically, so I'm not going to go and pull those numbers for you. Let's just talk about 2020, and let's talk about everything below the threshold. So let's take a comparison, and I'll explain to you why you have to tread carefully before you convert. So here's your Schedule C, and remember, that's your LLC, all right? And here's your S Corporation. And let's say we have a situation where our taxable income, this is for single taxpayer, single, all right? And the taxable income is below the threshold of $163,300. So that's a very simple scenario. This is going to apply to many single people that are just starting out, all right? And we have profit. So here's our profit of $80,000 from business. In scenario 1 and scenario 2 is an S Corp. Now, with the S Corp, remember I said we have to have a reasonable salary, and that reasonable salary would be $60,000. Okay? So now, here you have zero W-2 because Schedule C, sole proprietorships, disregarded entities, they don't run a reasonable payroll. They don't have any such, any kind of reasonable compensation requirements. Remember what I said, it's a simpler form of doing business. So there is none of that. No payroll processing, no separate filing, nothing. Now, the S Corp will be taxed on this. Your W-2 will be taxed for Social Security and Medicare, and that's 765%. Okay, so 765% is going to be $4,590. Okay. And that's going to bring us to what we call our profit for QBID. So profit for QBID here is still 80,000. That hasn't changed. But here, our profit's 15,410. That's a very, very low profit. So guess what, guys? Your QBID is very low. It's 20%, right? So now let's do the QBID, 20%. Here's our 20%, that's going to be $16,000. I'm getting a deduction of $16,000 as a Schedule C. Here, I'm only going to get a deduction of $3,000, which is 20% of $3,082. This is my deduction from taxable income. So how much in tax savings is this really going to mean? So at 22% marginal federal income tax bracket, I am going to save on this scenario as a Schedule C $3,520, and here a whopping $678. So where's the bigger tax savings? Here. I'm saving $3,500 versus $678 doing business as a Schedule C. Let's do the comparison further. Keep this in mind. I don't want you to lose focus on this. Now, let's compare taxes to taxes before accounting fees. Let's continue with the Schedule C on this side, S Corp on that side. Self-employment taxes, the dreaded self-employment taxes. Doing business as a Schedule C, sole proprietor, LLC, disregard entity, whatever you want to call it. What was the big hoopla before 2018? You'd have a ton of self-employment taxes. All your profit is subject to self-employment taxes. We take that 80%, we multiply it by 9.235%, and then we multiply the result by 15.3%. And the outcome is $11,304. That's the self-employment tax. Huge, right? Here we don't have that. Here we don't have that. That was the whole deal. Because before the 2018 reform, on one side, you'd be paying $11,000 in a state that has no income tax or city corporate taxes or anything like that, and things are very simple. And here, all you would do is match the employer and employee portion at 15.3%. See our reasonable comp video, all right? And your total tax would be $91.80. This was the biggest legitimate way to save money for years and years. Everybody was like, well, why in the world should I start up as an LLC? I'm going to pay all the self-employment taxes, and you know, the more money I make with the S Corp, the better off I am, because I just run a reasonable salary and I'll legitimately save a lot of money. I mean, people have saved countless of dollars, and I'm talking about, you know, the bigger the profit, the bigger the savings legitimately. So you could already see the tax savings. But QBID changed all this, right? Because QBID, here I'm saving $3,520 for this scenario, okay? And here, what am I saving? $678. Plus I have here, so this was my savings at 22%. And then there's also unemployment tax. Unemployment taxes here for running the payroll. This is minuscule stuff. You got to add it back. So let's compare now taxes to taxes. How much taxes did I actually pay here? $7,784. Here, $8,752. I clearly saved money like this. And this is before the $3,000 in accounting fees. Here I might have accounting fees of $1,000. Accounting fee. So now you can see why it's so important to not rush out and make any decisions about how exactly you're going to run your LLC before you speak to somebody that understands the intricacies of qualified business income deduction and how it relates to your specific tax situation. Because besides this, there's other variables at play. If you're married, if you have other sources of income, all of a sudden you're going to take this and make it even more complicated, and none of this might no longer apply. So again, this is a very specific situation under a very specific year, under a very specific type of work. So don't run out and take this as an all in all, and that you can automatically start off your business as an LLC and just go good with that. That doesn't always work. It's not for everybody, and it's definitely not for every industry. So there's definitely that caveat. So just keep that in mind. Again, you can always count on us to give you the best guidance. This is what we do all year long. We're here. We're always researching all the latest concepts and tax topics as they're surfacing and evolving. So just would like to make sure that everybody understands the complexities of the tax code, and just don't run out, don't get your S Corp right away without consulting with a tax professional that understands the QBID and also understands how other variables would come into play and what it would ultimately mean. In the general rule of thumb, most businesses will be better off starting off as an LLC and going that way because it's simpler. There's definitely going to be an opportunity to convert down the road, like I mentioned, so it gives you a lot of flexibility. It still gives you that layer of protection for legal purposes and offers you something the same as an S Corp would. So don't think it's a bad way of starting off, and it sounds worse than the other. Anyway, so that's our video presentation today on LLC versus the Schedule C versus the S Corp, and the pitfalls that you might run into if you rush to make an election to be taxed as an S Corp for your business. Thank you again. Freeman CPA signing off. Remember, your success is our success here every day. Thank you.